Sullivan. I'm a former IRS agent, revenue officer, teaching instructor with the IRS. I worked at IRS for a decade. I worked about 10,000 cases. I'm a national expert in all IRS matters. I have a whole team of former IRS agents on staff. I've been on the national news at least 10 to 12 times. They keep asking me, so I'm there. If you want to see my interviews on ABC, Fox, and all the stations, Newsmax, News Nation, just go to my website at 777irs.com, and you will find those. More importantly is the team that works with me. I do those videos for, oh, by the way, you can book a calendar appointment with us if you need to. I do these videos for 3 reasons. So A, you don't get ripped off. 2, educational. 3, I give you inside tips. I'll give you inside tips, insider stuff from the IRS. I should, after 50 years, know what I'm doing. So today, I want to explain the trust fund penalty to you. It's really important. People get all frazzled by this. They don't know what it is. It's hard to understand. So I want to walk through this process with you. If you get a pen and a pencil, it'll be very helpful. So pause this video and just get a pen and pencil and just keep it there, because I want you to understand what the trust fund penalty is. As a former IRS agent, I would go out and I would go ahead and investigate people and businesses that did not pay their payroll taxes. So my job was to go out there and seize assets if necessary. But many times I'd go in and work agreements out on back 941 tax debt. IRS, though, has a tool called the 6672 penalty, or the trust fund penalty. It's a really bad name, the trust fund penalty, to collect the money that was supposed to be held in trust with the responsible officers who was in charge of that business. So if you ran your business and you signed checks, you were on the corporate resolutions, you were involved in the hiring and firing, those are the people that IRS wants to go after to collect. And I'll explain the trust fund tax in a minute to you. So my job as a former revenue officer, and that's who sets these penalties up, was someone like me, so I know how to get out of them if you need to. Possibly, I should say. So you go in and you do an examination on the corporation. You ask for certain records, or you summons them at banks. You do a 4180 interview, and you determine who's responsible for the tax. Once you do, you make a recommendation that these people should be held responsible. They send you a couple letters out, 2751, 1153, and says, we want to hold you responsible for the tax. If you don't appeal it, IRS is going to create an assessment against you. So let me explain to you what the trust fund penalty is. First of all, the word penalty is bad. Let me explain why. The trust fund penalty is really part of the corporate debt that's owed. What IRS does is they take the money that you held in trust and they charge you for that money held in trust. So what IRS does is they're going to add up the withholding and the half of the Social Security, and they're going to assign you that debt. So here's the pen and pencil that I want you to do. I want you to pretend you owe IRS $13,000. So I would like you to write $13,000 out. You're going to understand this clearly when I'm finished. So if you owe IRS $13,000 on a 941 debt, this is how this works. $5,000 of that $13,000 was for withholding. $2,500 was the Social Security that you withheld from the employee. You had to match $2,500, and let's say the penalty and interest was $3,000. So you have $5,000 for withholding. You have $2,500 that you were supposed to withhold on your employees. You kept that. You had to match $2,500, and the penalties and interest were $3,000. What IRS would collect on the trust fund tax is 2 parts of that, the withholding and 1/2 of the Social Security. So they would ask for $5,000 for the withholding and $2,500 for the Social Security that you withheld. So IRS is now going to transfer that withholding, the trust fund tax, the money you held in trust, they're going to go after that for you. IRS will not collect the Social Security that you were supposed to match, or the penalties and interest, it just goes away. Now remember this, that if IRS assesses you the trust fund tax, it's part of the whole debt. It's not an addition. So if you owe $100,000 and IRS assesses you the trust fund penalty $60,000, that $60,000 is part of the $100,000. It's not an addition. So you are going to be responsible, and they're going to go after that 60. Should you pay that off, that trust fund, your corporation now gets that $60,000 credit. So the company would only owe $40,000. It's a little confusing. Just understand IRS wants to collect two things on trust fund: the withholding and one half of the Social Security that you withheld. I call them protective assessments. IRS wants to make sure they're getting that withholding and Social Security from you that you withheld. Why? Because you issued W-2s to people, and IRS is giving out credits for that even though the money's not in. So if you have questions and you're going through the penalty and you owe payroll taxes and you need someone to defend yourself against the big bad revenue officers, you should call us. We can help you. I hope this helped. I hope I added more light than heat. If I did, please give me a subscription. We thrive on subscriptions because YouTube says it's important. If not, it wouldn't make a difference to me, but it's nice to have them. Thank you so much for listening. I appreciate you. I hope I didn't add confusion to you. Thank you.